I'm Bob Landaas, president of Landaas Company. One of the most important issues when you invest your money is to get the mix right between stocks and bonds. Many investors struggle with that issue. Typically during a bull market for stocks, people obviously want more stocks in their portfolio, and just the opposite, when the markets are getting clobbered, people want more bonds. Way back in 1990, Harry Markowitz got a Nobel Prize in economics by convincing the academic community and then ultimately the Nobel Committee about asset allocation. And what he showed was that if you get much past 55 to 60% in stocks, your risk line keeps going up, but your return line tends to flatten out. And of course, it's a function of how you backtest it. We've been looking at this for almost 30 years now, and the results don't change much from year to year. And frankly, the last 5 years, the results have shown that you'll actually lose money by increasing your stock exposure past 65%. So as a firm, we try to struggle with balanced portfolios. In theory, it's easy to explain. In reality, it's hard to implement because most people want to avoid stocks on the way down and they want to increase their stock exposure on the way up. Of the 8 major downturns since I started in 1975, nobody called 4 of them. 9/11, the Persian Gulf crisis, the crash in '87, and the Arab embargo when I first got started in the mid-'70s. Nobody called them. Now, plenty of us called the other 4. So the other part about building a balanced portfolio is the concept of humility, that it's very difficult, almost impossible some days, to forecast the future correctly. So the pros know that it's tricky. If the world doesn't change, I've got a reasonable chance of having my forecast come out right. But in most years, it's that proverbial meteor from outer space that blindsides the pros. And so that really is what balance is all about. Stick to your knitting. Don't let your stock portfolio go much above 55%. Don't ever succumb to the concept of this time it's different. It usually isn't different in the classic business cycle.